Hi, everybody. This is Michael Collo, the Curious Quant, and I'm sitting here somewhat remotely, as we all are now, with my favorite risk quant, Nick Wade. Hello, Nick.
Mike, that sounded very creepy. You've now made me very nervous. Thanks for inviting me.
This is what happens when you stay in quarantine for too long. Certain types of behaviors are reinforced. It's funny, when I did my PhD, there's a bunch of my then peers who ended up staying in academia, and there's a bunch who ended up going to private sector. And the ones who ended up staying in academia, you kind of revisit them 5 or 10 years later, and you see that certain tweaks or certain habits, they've kind of just become reinforced, like little kind of idiosyncrasies, I suppose, of character, because there isn't anything to chisel it away. There isn't a group of social misfits or bullies or whoever that kind of brings you back in line to normality. You're just allowed to kind of grow off into your little tangent.
I think it's the same with quants, Mike. That's where you're going.
I think we all become like that with quarantine. I think that's where I'm going. I think it's a quarantine thing now.
Encouraged.
Exactly. But listen, I am here to talk to you as a flash pop-up podcast. I think we wanted to do this as a way of kind of saying, look, stuff is going on in the world. We wanted to talk about normal things, which is about quant and research and all that kind of good stuff. But in this case, I really, really wanted to get somebody in from one of the premier risk organizations in the world to tell me about what the F just happened in the terms of the risk modeling kind of framework, in the terms of how we think about risk in portfolios. Has this broken any models, or is this just kind of a unusual event, but it's not a big deal and we'll kind of get through it?
I think it's the latter, unusual event. I don't think it's broken any models. If I can give us a marketing plug for a second. Cheers, Mike.
For those of you on podcast listening, this means that we have had a comfortable glass of wine, but we do have a YouTube recording of this if you'd like to witness the event. But please go ahead, Nick.
Transcript is alcohol free. That's just going to say that we started making adaptive models in the late 90s. So what I mean by that is a risk model that's where the factor structure can adapt and learn as the market changes, or one that's explicitly looking for forward-looking signals. So something like what's going on in implied volatility world, what's going on with the news, obviously something that's relevant to today, because we want the risk model to know, just as we know, that there's something different about right now that you won't see in historical return data. So in that sense, I don't think it's broken any of the models. Those have been doing what we would expect them to do, right? The number of news stories about particular stocks, airline industry, insurance industry, supermarkets, whatever, toilet paper manufacturers has been going off the charts. Therefore, volatility for a large number of companies and sectors has been going way up. The question really is, what does that imply? What else can the market tell us about how long this pandemic's expected to last?
So I suppose what you're saying is in the immediate impact through March, I suppose, primarily to some degree February as well, of this pandemic and these set of events, basically means that we've had obviously a pickup of idiosyncratic volatility, pickup of cross-sectional volatility. Have we had very strong factor returns, by the way? Have you seen much in that space, or has it been kind of more just very short-term noise?
A lot of short-term idiosyncratic stuff, but then also some on the factors as well, but typically pretty broad. But where I was going to go to with that was really thinking about what the risk models and what the data can tell us about the market's expectations about how long this is going to last, which I think is quite interesting. So if you look at the numbers, sorry.
Tell me. I'm eager to learn. How long are we going to be stuck at home drinking wine?
Well, unfortunately, no. The market seems to be expecting 7 months, which is probably a bigger number than you're expecting, but not forever, basically.
So tell me about where that number comes from. How do we get to it?
So increase in volatility, and then the market correction in terms of the return drop. So if the market was expecting the current state of play in terms of the volatility to persist forever, then we would have expected the market to drop something more like 75% rather than 20%. So because it's only dropped something like 20%, that has some return implications. And then we can also think about how long the average company lasts. So something like 20 years typically. And then if we think about having that elevated volatility for some period of time and then normal volatility for the rest of that 20 years, we can then sort of back out what that means in terms of how long this elevated volatility is expected to last. And that gives us a number of something like 7 months. This is making some very broad averages, 20 years for all companies, and we're ignoring a bunch of fine print there. But very roughly, that's what a 20% decline in the market tells us.
So is this kind of like a return to kind of is this kind of relying upon a kind of equilibrium notion of volatility or equilibrium notion of behavior of companies in the market? And so therefore what we're talking about really is okay, so the relatively to the recent movements in 7 months. But I suppose there's a couple of kind of questions around this kind of stuff. So how would in that type of model do we think about kind of second order or even third order effects? Because if I was modeling what's happening now in scenario land, which is obviously a different approach. So if I was using scenarios to model what's happening, I would say, okay, there's a scenario that says pandemic lasts for 7 months. There's a scenario that says we find a vaccine miraculously that already exists in vast quantities everywhere in the world. We hand it out and it's all over in 3 months. Or there's a different scenario, which is 12 or 18 months. And I get the sense that in each of those different horizons, there's very serious secondary and tertiary repercussions regarding, how many of these businesses actually survive set 20 years. If, for example, airlines need to halt, 80% of their traffic for the next 9 or 12 months.
Yeah, exactly. Again, so I think the preliminary analysis based on where it's dropped to as of last week, let's say, tells us 7 months. But as you say, if there's suddenly a rash of new announcements that say we found a vaccine or actually it's twice as dangerous as we thought, then the market's either going to bounce up massively or take another tumble depending on what those news stories say. So again, plugging our stuff shamelessly, I would say, sure your risk model reads the same news reports that you do.
And I think that's quite interesting. And I suppose there's another interesting kind of question is, I remember being in a conversation with somebody in January, and they were trying to say to me that the market is vastly underestimating this virus and pandemic. And I was very much arguing for essentially a semi-efficient form markets. So, well, actually, based upon the current information set we have, I think prices are fair. But in some senses, either blows over and nothing happens, in which case prices should be much higher than they are, or it becomes much more serious, in which case they will be much lower. But they're never going to be the average that they are today. I mean, do we think that the market, if there was such a thing as the market here, is a reliable gauge of the future, given its recent track record, or do we kind of think they're not?
I think that brings us down to who's trading, right? I mean, we've got some investors who should have a very long horizon. Let's say the superannuation part of the industry, who should be able to take a decades-long view of what's going to happen, which is in the best interest of their members. And then you have the turntables change on them with changes in regulations. Okay, so now we're going to allow large-scale redemptions for people. That suddenly forces the super funds to have a much shorter time horizon. That's what immediately comes to my mind.
And so therefore you have a lot more kind of forced liquidation, right? You have a kind of a change in horizon, and you have this kind of liquidation problem where, again, in a kind of a GFC type manner, you've got a bunch of selling that is happening by necessity, and it's essentially price invariant, almost in price invariant.
Yeah, so then you've got two problems, right? You have those want to sell trades or want to buy trades, and you have to sell and have to buy trades. And none of us really want to be exiting at the same, because we have to at the same time that everybody else is trying to exit. Right? So that causes obviously considerable downward pressure on prices if we have to do that. The other option, I mean, I know, for example, some of these super funds have been taking a bit of a beating in the media about being heavily invested in illiquid assets, and how that's obviously, I say, quote unquote, obviously a bad decision given the liquidity issues and having potentially to meet redemptions. But most of those super funds have huge reserves of liquid assets that they could potentially sell. There's no need to rush into liquidating the illiquid assets at a fire sale price, or alternatively, they could do what Harvard eventually did, which is borrow against those assets as collateral.
But I think
permitted by the
100% agree. But I guess the point is, if you have a ironically, if you have an illiquid asset portfolio, let's say 25% in a growth portfolio, and 75% is other stuff, mostly equities and some fixed income, some credit, whatever. And then the value of a lot of those assets gets hit by 20, 30%. So now you're off your strategic asset allocation benchmark. So in some sense, yes, you're not illiquid constrained, but you're now off your allocation target, your dynamic asset allocation target. And so I think in order to get you back into that dynamic asset allocation target range, you need to either write down your liquids to the same amount, or you need to do something else. So it feels to me like you kind of get caught a little bit with the benchmarking issue if you just focus on the liquidity issue and you kind of let basically ensure that you have enough cash by selling then even more equities. And so before you know it, let's say 40% of your portfolio by weight is now illiquids because they haven't been rebranded or repriced. And then that's kind of an issue in terms of, I suppose, what happens when there's a rebound or whatever else, right?
Yeah, exactly. So there's sort of several issues in there, right? So on the one hand, there's the question of what is the value of those illiquid assets, right? So I think a lot of funds are hesitant to, shall we say, to revalue those things too often. Australian Super, I know, revalued some of their illiquid portfolio slightly after there was an announcement made that those redemptions were possible. I can understand, they obviously don't want people taking out money that doesn't really exist because it's a mark-to-market problem, if you like.
Yeah, and I think it's a really kind of interesting issue again caught between the liquidity issue and a kind of an active management type issue. Because I think the other way you could think about this is in times of liquidity constraints, it's exactly the role of a long-term asset owner to step in and to provide liquidity and then to obviously be compensated for it. So this idea of where do you generate your returns? One school of thought would say it's exactly in moments like these. So you might do nothing for 9 years. You might sit there gliding up with the markets. And then in that moment where there's a market disconnection because of liquidity issues is exactly your time to shine. I mean, from a risk
or your time to buy. Right? I had two discussions actually earlier on today, one with a wealth manager and another one with one of the smaller super funds. I'm sure they wouldn't mind me characterizing them like that. Both of whom had very large cash positions and were going to go shopping. This was a great time potentially to buy in.
And I suppose again, if you're not liquidity constrained yourself, you could do that. But I guess some of the more kind of scary stuff was that if you have a average super account of, I don't know, 40, 50 grand, and then the person is able to withdraw up to 10 grand of their super, then that's a pretty, you suddenly become, you go from being a long-term investor to being kind of medium to short-term investor because suddenly your redemptions come your way with market.
And I think, and if you think about it from personal perspective, if you have $40,000 in your superannuation fund, as you said, and you're going to withdraw a quarter of that at the market bottom and lock in those losses, that's probably not very good advice.
Yeah, no, that's right. But again, I don't think none of this is about kind of long-term financial credibility. This is more about a reaction to a very uncertain situation that I think is, highly changing and transitory. So I guess, okay. So aside from the role of asset owners, which I think is a really interesting one in Australia, but also more kind of generally globally, do the asset owners now step in? Do they provide capital for financial markets? Do they capital maybe provided also for infrastructure and unlisted assets? And I think there'll be a lot of this type of almost nationalism level that these type of funds to go and, as you say, go shopping or to kind of reinforce the economy, because essentially otherwise the weight of burden to support all these people that are out of work for 6 months or that require assistance will kind of fall upon the government. And essentially it's, the government's backstopping everything. They're backstopping banks, they're backstopping those things as well.
Yeah, but I mean, to some extent, it's a good opportunity for the government, right? I mean, if the government is able to offer people loans, surely that's better than tapping your super fund. If the government is able to offer an industry or a company a loan in return for an equity stake, maybe it's a good time for the government to step in and help. That's not nationalizing something, that's helping.
I think it's a pretty slippery slope, right? I mean, if you look at RBS, that was, they offered to take all the equity because otherwise, stuff would have gone bad. So I don't know, like we are in a weird state where you might see a bunch of industries companies being nationalized because they need to play a role in the national survival of an economy or a set of people, right? And so therefore, this notion of equity or debt holder is not as prevalent. On the other hand, I suppose you can have a more traditional top-down QE method, which just says, look, we print money and we buy your bonds. So essentially, we are your debt holders, and so we're not going to foreclose you. And as a result of that, you can continue to operate. So I guess the other question is, you guys had some thoughts and some material that you put out around not just how long, but I suppose how you think about this crisis evolving into financial markets and risk awareness. So maybe I kind of want to take you further than the 7 months that you were talking about, but you were mentioning at the beginning that this is not perhaps a critical moment, but this is a kind of unusual moment in factors or in volatility and cross-sectional volatility, etc. But I guess the question is, are we going to see a series of risk models like we did after the GFC that are going to try to adjust for this period in history? And are we going to see now, factors that will be supply chain relationship factors or criticality under pandemic factors or all this kind of stuff? I understand in your case, I think in your models, you have a dynamic element that allows to transform itself, whatever it needs to become. But I guess more kind of thematically, do you think the conversations will now, like how many models is this going to break? It's like,
yeah. So as usual with the Mike Collo cluster bomb question, there are at least 6 different pieces in there. So let me try and unpack that a little bit. So how many models is this going to break? If you have a traditional model with a fixed factor structure, yes, you've just introduced a sort of gigantic spike into your estimation window, your risk model history, and your risk forecasts are going to look higher because of that for quite some considerable time. You can get around that a little bit by saying, well, it's an outlier, we'll just get rid of it, which is probably a bad idea. Some people have exponential weighting, which makes the significance of these types of events smaller over time quite rapidly. Or again, you can have an adaptive factor structure that sort of says, as this stuff happens, we need to know about it and we need to adapt to it. But then once it's gone away again, we'll just adapt back to this new normal. I think that's better. So more flexibility, I think, rather than more factors. I certainly think, going on to your second point about supply chain factors and various other things, I certainly think more macro factors is definitely a good thing. I think there's been a sort of trend in the industry to think only about fundamental factors or microeconomic factors. And let's sort of navel gaze at the inside of some company, and that sort of ignores the dependence on the broader economy, on other asset classes, on all kinds of other alternative signals that we can drag in usefully to help with our estimation. So yeah, I think we'll see a bit of a drift towards more macro factors, but hopefully it won't just be an additional 20 factors on sort of a non-adaptive broken model.
Yeah, because it feels like we kind of, as with the rest of humanity, we tend to be quite reactive, right? So we kind of see something in the data, and then that for the next, 10, 15, 20 years, every backtest will have this question asked: how did it do in 2020? Or how did it do 20? As we did with GFC.
Backtest.
Exactly. What did it do during the COVID? Oh, it was fine. It was buying quality stocks, and then it kind of went through. And so that it's going to be kind of, tweaked essentially to be okay during that very, very narrow window for a really idiosyncratic event. At least with GFC, you could have said, well, I can see some pressure in financial systems. I see a lot of leverage, a lot of bad debts building up. So, I feel like that whatever. How are you going to put that in? How are you going to put that in the financial model? How are you going to put COVID in the financial model? It's a lightning strike event.
Well, I think that's exactly the point. It's what was it, Donald Rumsfeld, that said there are known unknowns and unknown unknowns? I mean, the next big problem, we're not going to be able to predict the next big problem by adding 20 factors to the risk model today based on the last big problem or the one before. I honestly believe the only way that we can help forecast the next one is by having a structure that's adaptive. So literally being able to learn these things as they happen rather than try and think ahead. I don't think as you said, this sort of lightning strike stuff is particularly forecastable. Although World Health Organization and various other people will probably tell you that there was one of these coming. It was just a question of when.
Okay, but I mean, I guess in that sense, I don't really see it different to an earthquake or to a meteor strike or anything like that. Like, it's a force of nature that impacted a huge sway of the human population. I think in COVID, perhaps maybe one of the things that is different about it is that it's gliding through the population over time. And so, we can kind of have a reasonably good sense of what happens when it hits certain countries in terms of the speed at which it will hit, what will happen, etc. So in that case, I think if you can forecast the movement of COVID, you can probably forecast the effect on GDP, economic activity, etc., if it's not already locked in.
Well, and then that differs across countries depending on the structure of the healthcare industry and demographics. There was a lot of talk early on in this epidemic about sort of an asymmetric effect on different age groups. You can make the argument that although the sort of 60 to 85-year-olds account for a lot of the wealth in developed countries, they don't account for so much in terms of GDP or productivity or something.
No, I think they are potentially consumers or certainly wealth holders in that context. But it is fascinating because I think it's not so much like, here's a kind of a very sad but kind of abstract thought, is that if COVID did not require ICU hospitalization, if there was a random 0.5% probability, 1% probability you would just die from COVID, then effectively a lot of these conversations about resource planning and whatever would be very, very different, right? So they would be much more like, okay, nobody can get it and we need to slow it down and whatever. So I do get the sense that economically, most of the damage is going to be done by the quarantine measures that are in place to protect human lives. So the shutdowns essentially are something that's quite unprecedented in terms of the fact that we're kind of realizing economies are not seasons, they're shocks. Right? If you stop swimming, they die, right? As opposed to they go into hibernation once a year, for whatever, 3 months or whatever. So I feel like I think we're learning a lot about the fragility of our economies, and again, and for once, I mean, before we learned about fragilities of capital markets, I think in 2008. I think we're now learning about fragilities of economies themselves and maybe the human labor component as well. Do you think that this will kind of impact the way that we think about modeling as well? Because I guess if we feel like every certain number of years, there's a kind of a random event that comes in and kind of wipes us from a modeling perspective or from a kind of a return strategy perspective, knocks us out of strategy very significantly. Surely we would kind of do the idea of abandoning a lot of these type of long-term forecasting, backtesting type methodologies and basically aim for a kind of nowcasting, live in the moment kind of approach. Do you think that it's going to go that way, or do you think this is kind of overshooting a little bit and in 6 or 9 months or 12 months we'll kind of be like, oh yeah, that was nice, but here's a 20-year backtest anyway?
Yeah, I mean, honestly, I think the industry as a whole, unfortunately, struggles to learn from history. So I strongly suspect 6 to 9 months from now, we'll be saying, okay, so it's game on again then, and back at it. But what I hope we'll also do is think a bit more deeply about those individual companies that we're investing in and their ability to be resilient to whatever comes next. So possibly a bit more attention to how highly levered they are, or supply chain relationships.
So you see, there is going to be a new factor. The new factor is going to be resilience. It's going to be some subcategory of quality that will sit there going, I'm resilient. But, and I guess go back to the previous point, which is, I mean, it feels to me like this COVID thing is such a fascinating time because there's so many different themes that are kind of congregating, coming together. Everything from data privacy to the use of intelligence, to the frailty of human labor and all these kinds of different ideas. But going back to this idea of how, I suppose, fragile companies are or how resilient they are, is it not the case again with this type of scenario that we are going back to a model where the government's decisions ultimately decide the business outcomes and economic outcomes, as was the case with QE or as the case is with COVID, and therefore these models that we're talking about have no real direct measure of government action or likelihood or impact. They only kind of measure the secondary, third waves that happen from it, right?
It sounded like there was an undertone there of capitalism's great, but it needs socialism to bail it out every decade.
It's an interesting quote actually, and it kind of goes back to the classic. If you haven't seen the Hayek versus Keynes rap, you look it up on YouTube. It's brilliant, made by a brilliant director who's just a wonderful guy. And so it's basically this notion of, do you let the economy run, or let natural forces, live and die, versus do you kind of step in and control? And it feels like we're very much in a mode of stepping in and controlling. Like, it didn't take very long for the market to turn to the government to say, right, what are you doing about this?
Where's my bailout?
Yeah, yeah, exactly. Well, yeah, exactly right. How many trillions of dollars? Where's the check? Where do you sign? Right. That's what we're used to now. And so there's almost like an unwritten rule about since 2008, essentially, about underwriting markets. Maybe even before that, actually, Greenspan times, of kind of this notion of, you have to protect markets, so you have to protect us.
Well, it comes down to, or it comes around to an interesting discussion. I almost said more interesting discussion, sorry, about stakeholders. So you've got shareholders, obviously, but then perhaps we need to think a bit more about the bigger picture, right? Companies have employees, but if the company's going through a difficult period, it can't just tell the employees to sort of nick off until times are better and it needs them to come back. It has a responsibility in some sense, perhaps, to support those employees. The government's been happy to take tax revenues from companies. Maybe in return for that, it has some kind of responsibility to help in extreme situations when the companies are in trouble. I don't know. I think we need to reconsider the sort of implicit contracts or explicit contracts that we have with each other.
But that's an interesting point, because I guess banks have reserve ratios, or kind of rainy day funds that are mandated for them to have.
I think super funds should have the same kind of thing, to be honest.
Well, it's an interesting question, right? So at the moment, it feels like a lot of the economy has been living in a kind of Mediterranean environment where there is no winter, and you're essentially just kind of eating whatever you grow constantly.
Right.
Whereas I think, if you're living in a Nordic state or whatever, you'd be expecting to have no harvest for 4 months of the year. So you would kind of live much more cyclically. And so therefore, I kind of do wonder whether corporations would be mandated to have levels of cash and reserves to be able to continue running their operations at a much lower level of capability, or at least maintaining worker salaries and so forth, for a period of up to, I don't know, 3 to 6 months or something like that. In the same way that you have reserve capital ratios for banks, or you have other kinds of things mandated, so that if there is an exogenous shock, then those companies survive.
Yeah, I mean, we advise each other to have an emergency fund around a certain number of months of money in the bank. Perhaps companies should have the same advice. I was also thankful there that you stopped before you mentioning the Donner Party with the struggles with harvest and stuff. But never mind.
The Donner Party?
Yeah, they were to migrate west in the US through the mountains, and got stuck in a snowfall and decided to wait, and then more and more snow fell. And then they eventually ended up eating each other. But
oh, lovely!
sort of
Thanks,
Nick.
Nick. Yeah. Thanks, Nick. That's a different kind of human resource, I think, that we weren't really thinking about. That type of human resource, perhaps. But I mean, I think food security has long been, just speaking about that as well for a second, has long been kind of considered as one of the kind of biggest risks to, I think is called out a couple of times in World Economic Forum meetings and Davos and those kinds of things as well. Things that we need to consider. What about globalization? Do we think that this is going to do some kind of denting to the idea that, we should all be together everywhere all the time?
Again, I think several different directions on that one. It's if you look at the supermarkets, it's done some interesting things. The sort of quasi lockdown that we're under seems to have limited us a little bit to more local rather than, or definitely local rather than international produce. Right? I mean, there's no particular reason why we should be importing fruit and vegetables from other places. Perhaps maybe we should eat local. I don't think this is going to go on long enough to make us start questioning whether we should make all our washing machines and cars close to home or anything like that. But yeah, I do think it has some implications for trade.
Yeah, because it feels like it's a reminder that there's a cost, or there's a risk to these type of trading routes, or kind of these connections, right? I mean, I remember a wonderful presentation from the Bank of England a couple of years after the GFC, And I liked it so much, I ended up kind of downloading. It was a kind of I think the reserve governor, or so the deputy reserve governor was giving it. And the idea was that he was comparing the financial system to a kind of a biological entity or biological system, where because of the homogeneous channels, and what he was talking about is the idea that everybody measured risk the same way. But because of these homogeneous kind of channels, essentially all these different entities around the world had the same picture of what risk was. And so because of that, a contagion, or kind of a risk, in that case, a financial risk, could travel through that network completely and fast and with absolute without stoppage. And obviously it's much easier to imagine that in terms of a human contagion, right? So kind of humans traveling around the world with airlines and so forth. And that's kind of why that's been shut down as a kind of priority. But it feels to me like a lot of the imbalance, let's say wealth inequality and other things in the world, has come about because the idea that goods and services can travel the world unabated, but labor cannot. So you cannot relocate to Chinese coal factory because your local coal factory was shut down. And that was always kind of missing piece in a lot of the world's imbalance, where Europe said, okay, as long as capital can move, people have to be able to move. And that's why the whole freedom travel thing was there. Whereas it feels like if viruses are here to stay, and I'm not suggesting that they are, I think we're having this conversation now, but in 12 months' time, we could be all gone. Then it feels like that, again, reinforces the current paradigm, which says people can't go anywhere, but technology can, software can, goods and services can. So Netflix can still run our televisions remotely, but we can't easily kind of move between places.
Yeah. So once again, a bunch of different directions. I mean, the obvious impact has been migrant workers, right? So Spanish farmers complaining that all the people they normally depend on from Morocco can't come over and pick the harvest for them. I'm sure something similar is probably happening in some of the southern states in the US. So that's one issue. Something else, thinking about some of the inequalities that you mentioned, are the way that this virus seems to affect people differently across different demographics, which throws a bit of a light, particularly in the US, on this idea again of universal healthcare. I think the US is the only developed market that doesn't have universal healthcare. I might be wrong on that one. But I think part of the resistance over there to more widespread testing could be because of the cost and the fact that even if the tests are free, the doctor's treatment is not going to be free. The vast majority of people don't have enough coverage, question mark.
No, that's 100% right. And I think there's this kind of a devastating alignment in pure capitalist economies between value or wealth and, health, obviously. And this idea that you don't have a right to good health just because you exist. You have a right to it because you're a productive member of society or because you have wealth.
Yep.
And this kind of alignment is there. But that's why I think, it's a really interesting kind of way that different kinds of economies and countries will handle this in terms of how humanitarian they are, how much wealth they have, how much capability, how much control they have, how much do the citizens believe that the government has their best interests at heart? How compliant are your citizens, for example?
Yes, exactly. How much control do you let the government have, right? So some countries, it was very easy, I think, to just ask everybody, please use this tracking app on your phone, or, oh, by the way, as you know, we're watching where you go all the time anyway. Whereas other countries, I think, resist any intrusion on their freedoms.
And I think this is where it kind of is almost like a data privacy couple of things as well. Like I kind of, if I draw some straight lines from this going forward, you have a common enemy, so to speak, and entire humanity has this common enemy. So it's not even like, you can't even say to me, well, according to Chile, this is not really a problem about pandemics. This is a problem about oil prices or something like that, as was the case in GFC, where you were like, well, Lehman Brothers kind of hits, I don't know, New York, London, a bunch of other places. But then for everybody else, it's other problems. It's about manufacturing downput. It's about oil downput, etc. And here, everybody, the common enemy is absolute. Like it's the virus, it's COVID. That's why you're in lockdown. That's why you can get kind of sick. So I don't know. It feels to me like things like state control, centralized control, the good of the many, all these type of arguments now come to the front, and they come together so quickly that everything else gets censored in light of this idea of a common, path forward. And while that seems like a really good idea today, because the flatten the curve movement and so forth is all true, By the way, I'm not buying into the 5G conspiracy theories, but I guess I'm thinking also more, how quickly will that centralization of power be relinquished again?
Well, look what happened with the Patriot Act. A certain sense of emergency, and then some freedoms disappear, and not temporarily. Right. So we need to try and avoid, I think, that kind of a repeat or something similar happening in this case.
It's very difficult. I think when you kind of seize power to that level and you create a bunch of tools and other things in a good, even in a good way to help people, some of these movements are hard to reverse. If not, they kind of can create a generational, they flavor entire generations approach to, I don't know, how to control your population or how to mobilize different resources, etc.
Yeah, but I think picking up on another part of what you said, this possibly will help people change. A couple of examples there. I mean, we've had the technology for everybody to be able to work from wherever they wanted to for decades, right? I've remote worked myself for 20 years. My kids have absolutely loved doing online school for the last couple of weeks. They feel they're getting a lot more done than when they're actually in school. The teachers are setting more work. Everybody seems to be quite happy. We don't have driving them to school and all that sort of rush. Possibly at the end of all this, those are just two examples. Possibly at the end of all this, we realize that there are a lot of things about the way that we work or the way that we educate, things that we just do day after day because that's the way we've always done things, that really can change, and in ways that improve people's life. I'm not suggesting we should self-isolate for the next decade. That sucks, but there are obviously some things that we do now that are different and better than what we were doing before.
And I think it's there's a friend of mine who's called this the great pause of 2020. And I thought that was a really interesting way of kind of calibrating it because, from their perspective, they are certainly not in a better financial position or anything like that. But there's this moment of kind of taking stock and kind of getting off the ride for a second and saying, okay, where is this going? And I was kind of, all the articles that are coming out about how much lower the environmental emissions are, the kind of pollutant emissions are across the world, from all the different cities and everywhere. And so nature's coming back, wildlife is coming back, etc. And then you kind of think to yourself, okay, so that's what climate action looks like. Ironically,
exactly.
That's actually what it looks like. That's actually what it looks like. Yeah, exactly. That's actually what it looks like. And now they can see, in India, they were saying now they can see the Himalayas. They didn't see them like 20 years or something.
Yeah.
And now we can see.
Yeah, I read the same article. Yeah.
And you're like, wow, okay, so this whole idea of being at the edges is really still under the slavery, let's say, or the control of a relentless economic machine. But if you stop that economic machine, is the only time that you shut the factories down and the smoke stops going to the sky, and basically nothing else will do that, right?
Right. I mean, I think what we normally see is a huge amount of innovation in technology during a war, right? Fast steps forward in terms of technology, and I think I hope that we'll see the same kind of thing through this. There'll be at least some steps forward in terms of the technology that we use on a day-to-day basis.
And if you had to speculate, which I know you never do, but if you had to,
my gambling habit.
Exactly. If you had to get that twitch out again, roll some dice, what do you think is going to be the kinds of themes that emerge out of this whole thing?
You mean what are people going to do when they come out of hiding, or you mean what are people going to be fixated on, or?
Yeah. So I guess if we're sitting here in, I don't know, 2 years' time, talking about the great lockdown of 2020, I suppose the question is going to be, what did that lockdown really change that's markedly put its fingerprints on the next decade to come or more? Not that I'm putting you on the spot or anything like that with my cluster bomb questions.
No, but think of something really monumental and interesting.
And do it right now.
And do it right now at the end of an otherwise fairly long day. Yeah, that's a good question, Mike.
Well, listen, why are you thinking about your brilliant answer, which you could take your time. I'll give you my answer, and that will give you
there you go. Yeah, thanks.
Valuable time. Quick, start taking some notes in the background. But
I have.
Yeah, you got your pen. Very good.
Got my pen.
So I suppose I've come to believe that there's certain kind of trends that begin in times of crises, and it's not always obvious because at the time of the crises, there's so much stuff going on. But over time, when the dust settles and the randomness settles, and there's a kind of trend that continues. I think as a society, as a government, as a corporation, I take up on your point about the resiliency. I think we're going to look at our system of economics and say, how do we make this thing resilient? Which is another way of saying sustainable. Sustainable, not necessarily from an environmental perspective, but sustainable through a pandemic. And the kind of themes or kind of ideas that will come through with that is either you classify this as a risk, and you say, like, in case there's a pandemic risk, or these kinds of activities will cease. How do we ensure that we can continue to have business operations, that we still continue to deliver products, services, whatever else we need to do in a safe way? And I get the sense that, for example, technology as artificial intelligence and other systems like that, which we've seen automation, augmentation kind of grow, and we've seen some adoption in different kinds of industries, but primarily for the purposes of efficiency and kind of earnings and economics and so forth. You'll see a new strand of adoption for these kinds of technologies that will talk to the idea of what happens if the next pandemic is 30% mortality rate and it's airborne. At what point at that point in time, how would you like to manage your society and your economy? And so I think the answer will be, okay, we want to have self-driving cars that are delivering food, that are delivering medicines, that are, we want to have centralized information sources. We want to have obviously amazing virtual reality, whatever, interactive remote ability capabilities, so we can feel connected as much as possible, but essentially be protected from what will be outside, which will be this real danger elements of a virus infection. So I get the sense that a lot of the automation technology that is in the wings and has been kind of slowly drifting through society, or not that slowly, but kind of been drifting through society, will take an acceleration. And there'll be this notion of, hey, we need this stuff because it protects us, rather than we need this stuff because we think we can make more money with it, or something like that. There you go. That's my pitch.
Yeah. No, absolutely. I think, and then trying to sort of shrink that down to the very small corner of my world that I can actually comprehend, as opposed to the much broader one that you're talking about. It probably means an increased focus, very simply, on risk, right? So we've had the Royal Commission, we've had various other things, and gradually the spotlight has turned a little bit on what are people really doing for risk, and applying that just at the big end of the street, but at the smaller funds, for retail investors, for anybody, and for any asset. So I think that's going to be a big theme, and that's obviously one that benefits us. But I sincerely believe that risk is going to be a significant theme. And then something we touched on briefly on the way through there, sensible capital requirements, right? Whether that's banks, or whether that is individual companies, or whether that is you and me, what do we do if we get laid off from bartending for 3 months or however long this lasts? Obviously we can drink at home, but we need some form of income. Does that come from income insurance of some kind, or does that come from some emergency fund somewhere? And then I think clearer guidelines about the government's role in all of that, as you mentioned.
It'd be quite interesting if all the companies are mandated to provide income insurance for their employees for up to the period of 3 to 6 months, something like that, right? And that would kind of at least provide some backstop there, because I think it is probably not quite reasonable to put all of our collective fates in the hands of government, just because there doesn't seem to be any obvious other ways to do it. So I do feel like, there's a different thing. I mean, going back to the risk argument, there's an interesting question here, which is that last time that risk models disappointed us was in 2008. And I use the inverted commas because I think unreasonable expectations were leveled on these kind of risk models. But do you think that we're going to go back to this idea of, yes, we care about risk, but oh my gosh, we shouldn't use quantitative tools because, pandemics and meteor strikes or whatever are so random that they're completely unpredictable, and therefore we should use, I don't know, rules of thumb or whatever else?
I think in terms of event risk, or specific scenarios, it's probably easier to look at something like an agent-based model to play with. Or if you're thinking much longer horizon, you're beyond the ability of most of the quant tools that we use on a daily basis to really help. If countries cease to exist, if major meteorite strike happens, what's the world going to look like? The stuff that we use on a day-to-day basis, looking at historical security returns, are going to be of no use whatsoever, I suspect. But that needs more sort of bigger picture. And my preferred toy at the moment is agent-based models for that sort of stuff. You can play with some interesting scenarios with those. Otherwise, back to my same, repetitive story. Have an adaptive model. Have something that learns as the markets change. And two other sort of themes that are part of that. One of those is finding information in liquid markets and using that to adjust risk forecasts for things, whatever they are, maybe not an off-the-run treasury bond or a building or whatever, that are not in liquid markets, right? So find liquid information, transport it around to those less liquid or illiquid asset classes to adjust your views of risk. I don't think we can get by anymore by saying, well, those things are just too hard, send the valuer in and try and figure out what the building's. We should be able to adjust those things using other information.
And that takes you back to a kind of model. I'm kind of reminded a little bit of the Boston Dynamics models, Boston Dynamics robots rather than models, robots. Yeah. That when they walk through the forest, they kind of, if when they're about to trip or fall, when they get into difficulty, the movement speed up a lot. The same way you catch yourself before you fall over. And I think it's fascinating, this idea of kind of moving between slow and fast speeds for models as well, dynamically. So volatility picks up. And one idea is that when volatility is high, time is compressed. Many more things happen in a very short period of time. And therefore models need to be quite responsive and quick. And so therefore the horizon that you look back should fall with that view as well. But it'd be quite interesting to see how the fallout happens, because I think there'll be a lot of soul searching going forward here about what we've learned about capital markets, even from random events and the way that they propagate through capital markets, what we've learned about how correlation works in these different scenarios. But for example, we've learned a lot about BitCurrency. I mean, there was a great piece by Campbell Harvey, which he was talking about recently about various market movements. And one of his points was about BitCurrency and this idea that we didn't really understand what these type of currencies would do in times of crises, and now we know they sell off. They're just a risky asset. There's no diversification at all. So it feels like you kind of learn a lot more about these asset classes, but also you kind of learn about what happens when idiosyncratic shocks hit and how they dissipate throughout a market, and the kind of what you should do. And as you say, it probably falls into the world of scenarios, and maybe pandemic risk will be one scenario, one permanent member of the scenario tool base from now on that we'll all be kind of looking at, a 2020 pandemic risk scenario that will forever be in our stress testing.
Yeah, sure. So I mean, I think a couple of different things on that. I think the first time I heard about this idea of time speeding up and slowing down was Emmanuel Derman writing a paper in 2000 or 2001 after the tech bubble burst, and trying to explain things in terms of event time rather than calendar time. And I think it helps. We think about volume time when we're thinking about transactions, so sort of market microstructure stuff, and we can also think about information time, the arrival of news stories. Maybe they're bunched up, there's a lot of information going on, or maybe there are not so many stories, there's less stuff happening. So that's sort of one thing. And the other thing is we keep talking about the market, and I think all of us have a tendency, I know why, I think all of us have a tendency to talk about stock prices and bond yields and all that sort of stuff. But one thing I worry about increasingly, we really only got visibility into that listed part of the market or economy. There I go again, market. If you look at companies in the US, let's say we pick not just sort of venture capital and startups and stuff, but if we look at companies that have got more than 500 employees, so these are not trivial sized companies, these are pretty decent sized companies, 86% of those are private. And if you go through all the numbers, you find out that about half of the US economy is private. We really don't see what's going on with that. We only see what's going on with the public, the listed part of the economy, and then we sort of infer, well, it must be the same in the other half. But I think increasingly we really don't have full visibility of what's going on in the economy just by staring at the stock market. And particularly with other markets where there's just not that much liquidity and not that much trading happening, and you really don't get a lot of sort of price discovery.
I think that's a really good example of how a recession like this one, or let's say an economic shock like this one, we don't know recession, but it's likely. Um, we get reminded that there's a kind of ground up fundamental high street that gets hit, and then it kind of
Yeah.
migrates up. Whereas I think in a kind of asset price or liquidity crisis, it's very much the other way. It's the listed asset prices that get hit, and then that kind of permeates into credit availability and a whole bunch of other things down the line through probably banks and other types of intermediaries that have that systematic component to them. But I think, as you say, the really good point here is that there's a tremendous amount of businesses that have gone to the wall now because of the quarantine measures globally. And the vast, vast majority of these businesses are small to medium-sized businesses. And, all of the bailouts and all of the kind of, I suppose, government action, all this kind of stuff is really needs to get a really good handle as to what's going on in that market in terms of risk or in terms of uncertainty or in terms of capital liquidity requirements, etc. So we'll see. I mean, I saw some graphics on how much money in the US is at the moment slated to go into small, medium-sized businesses versus the larger businesses, which are the listed ones, and it's a pretty hefty ratio going to the large liquid businesses. So again, there's this kind of notion that capital markets rule the Federal Reserve and others' understanding of risk or kind of what's happening in the world, and therefore maybe some of the policy triggers are disproportionately pushed around by these publicly observable prices. As you say, the idea is that they're a proxy for the unlisted or the private side of the market, but that proxy is quite imperfect. So maybe it's a good reminder of that too.
Yeah, exactly. So you've got this part of the economy which is large listed companies, and then you've got a large chunk of it which is, as I said, these private companies. And I would like to believe, without looking at any numbers whatsoever, that that's potentially the more resilient part of the economy. So we shouldn't forget that that's there, and that's also impacted. We watch the stock prices of some of these listed companies plummet, and we assume that that's a reflection of something going on in the underlying business, whereas it may have nothing to do with it whatsoever. But obviously, that's not happening for the private companies.
Yeah, exactly right. Well, it's been a thrill, as usual, chatting with you on this beautiful Thursday night here in Sydney, Australia. I think we're living through incredible times, and in some ways it's a blessing, some ways it's a curse. I think for those of us that are starting our careers or have not seen the GFC firsthand, we're probably bewildered and we're looking at screens and we're kind of seeing the collapse of growth or GDP or earnings or prices or whatever. For those of us that went through the GFC, there's an eerie sense of familiarity with how the dominoes are falling, I suppose. We'll see, history doesn't repeat, but it rhymes. And there's also a sense that there's probably a lot more to come in terms of the pressure in the system and what might happen in the next number of months. So hold on to your hats, I guess.
Yeah, I mean, I think there's a lot of oh no, it's the end of the world from some of the younger people, and then oh no, here we go again from some of the older people. So yeah, as you said,
not another
hat.
decade. Yeah, exactly. Not another decade. Well, put it this way: your savings accounts are not going to give you any interest rates for the next 5-10 years. So you can throw that out the window. Interest rates are going to be low for a while with the amount of money and debt that's being pumped into the system. And then I think there's another interesting question, which I'm not going to pull you into that conversation now as a cluster bomb, but universal basic income, right? We just arrived. We just arrived. We're here. And it turns out that a lot of these beautiful intellectual conversations that we could have had over this whole topic, just something else decided for us, right? So that's where we are. But thank you so much for your time again, and thank you for joining me for
My pleasure. Thanks for the
evening's chat.
invitation.
Pleasure.